In this week's video, we'll review the latest charts to help us answer the question, is the stock market rally running out of steam? We'll be moving very quickly, so feel free to use the pause button on your video player. The green horizontal lines at the top of the page represent potential targets that we've covered in past videos. In the remainder of the video, we'll try to assess the probability of the market pushing above those targets relative to the probability of a reversal. Before we move to a chart of the S&P 500 as of the close on Friday, June 11th, let's look at these charts from June 10th. This line where my cursor is represents the trend off of the March 23rd low in 2020, and the dotted line represents the trend from the low in November of last year. On Thursday, price was above this gap here and above the trend line here. And the pullback in May, or at least thus far, has held above this gap near the early stages of April. Not much change when we look at the same chart 24 hours later, or at 3:56 p.m. on Friday, June 11th. The NASDAQ in isolation has done some nice things. It's above all of these gaps here, and it also cleared this gap here during Friday's session. Next hurdle, a new all-time high. The NASDAQ relative to the S&P 500 has also made some progress. This would be step one for a probabilistic trend change, breaking this downward sloping trend line. Next, if you're a bull, you'd prefer to see a higher low relative to this low here, and then a higher high relative to the high in this area here. Keeping in mind the S&P 500 was able to close at a new all-time high on June 11th. All things being equal, we would prefer to see the Dow do the same, and we would prefer to see the ratio of a basket of diversified bonds relative to more defensive treasury bonds print a new all-time high. During Friday's session, or as of the close on Friday, June 11th, really not even close to having this ratio print a new high. As we've noted in the past, you have a divergence here in the ratio as the S&P 500 eventually printed a new high in February of 2020. Also noteworthy, when the S&P 500 pushed higher in November of last year, the ratio also printed a new high. This is the last highest high here, and thus we have a break of this upward sloping trend line where my cursor is, a break of the trend line, a lower high relative to this high, and a lower low was printed this week. That's far from a disaster. It simply speaks to probabilities and is one piece of the weight of the evidence. From a risk tolerance perspective, we would also prefer to see some improvement in this ratio in this area here. And while the NASDAQ is knocking on the door of a new all-time high, if we look at a technology ETF, FTEC, relative to TLT or Treasury bonds, it's not particularly close to exceeding the high from April of this year yet. This ratio has also failed to clear this gap here and this gap here. Like all of the charts that we'll cover in this week's video, we'll learn something if this ratio moves here, and more importantly, if it can hold in this area up here. And we'll also learn something if it backtracks down into this area here. If we look at the same ETF, FTech, relative to the S&P 500, we can see it still has some work to do in this area here. All things being equal, if you're a stock market bull, you would prefer to see this ETF print a new high and hold in the upper right-hand corner of this chart relative to moving into this area here. Like the S&P 500, somewhat of an indecisive consolidation pattern as of June 11th. Updating our NASDAQ Advanced Decline Volume chart, very easy to state that the present day chart as of June 11th looks a lot better than this region here and this region here. You can pause your video player here. This is the NYSE Advanced Decline line based on issues. This is the rally off of the March 2003 low. This is a retest. and then the big move in the stock market off of that low into 2004. You can see eventually the trend line was broken, and the advanced decline line made a lower low here. Similar situation off of the major low here in March of 2009. This is where the S&P 500 bottomed. Eventually, this trend line was broken, and we had a discernible lower high in place relative to this high. Nothing magical about these charts. They're not particularly helpful in terms of anticipating anything, but it does allow us to compare the present day case to this point in here and this point in here. It's fairly easy to say that as of 3:51 p.m. on Friday, June 11th, the 2021 case at this point looks better. Nothing earth-shattering here, but this is a noteworthy change. We were making a series of lower lows below this blue line here. We broke above it. This is a little bit of a retest look here, and then we made a higher high. It would be more convincing if we could move above the consolidation pattern as we did in November of last year. That falls into the to-be-determined category. 9 minutes before the close on Friday, not a lot of change on this chart. The NYSE weekly was down 0.2%. Small cap index, not unusual when we get a very, very strong trend like this, that a market will consolidate and go sideways and come back and tag a trend line. Similar situation here. We're extended from the trend line at this point here in March of this year, and thus far we've been going sideways. This is a point of reference here, the orange line, and both of these lines are a point of reference. We did pop up earlier in the week and make a new high here, and then 7 minutes before the close on Friday, June 11th, had somewhat of a failed breakout look. Bottom line, this has not resolved in any convincing way in a bearish manner or a bullish manner at this point. Keep in mind, from a bullish perspective, we would prefer to see something like this, a convincing move above the consolidation pattern and have it hold above the consolidation pattern. This move here after the consolidation here is in sharp contrast to this failed breakout here. We move above this high here on a closing basis, and then we reverse and come back and tag the trend line. No need to predict anything here. We just monitor all of these charts going into next week and see what we can learn. Remember we said the S&P 500 printed a new all-time high? Not so for the SPY-TLT ratio as of the close on June 11th. And at this point, it's hard to make the argument that our momentum down here is confidence-inspiring. If you're a bull, the good news is no serious breakdown here yet, more of a consolidation or paused pattern. The numbers are small. This is the 10 trading day rate of change here, which has dropped below 0. 15-day rate of change has dropped below 0. The 20 trading day rate of change is also below 0. All three numbers are negative, telling us that in the last 10, 15, and 20 trading days, SPY has underperformed TLT. Nothing earth-shattering, but it's not confidence-inspiring. If you're a stock market bull, you'd like to see all three of these rate of change numbers get back into the black. If you want to know what bullish moves look like, what confidence looks like, just keep looking at the move off of the October-November low of last year. See, this ratio makes a new high in here, and for the most part does it before the stock market, or at least in a coincident fashion. A lot of the ratios that we're looking at this week have not done that. The S&P 500 made a new all-time high. This ratio has not, and if we zoom in, that's pretty clear to see. If we move up here, it would speak to bullish probabilities. If we move down here, bearish probabilities. The VIX as of the close on June 11th, if it stays down here, make a check mark on the bullish side of the ledger. Australian dollar relative to the Japanese yen. This is your highest closing high where my cursor is. That's several weeks ago. Draw a trend line off of the March low. We've broken that trend line. That's somewhat of a step one. We've made a lower high here relative to this high. We don't have step 3 in place, which would be a lower low relative to this low. This look here tells us even if a downtrend starts, you always have to stay in the now. Why is that? Because anything can reverse at any time. If you're monitoring this with an open mind, then it's going to be much, much easier to spot a reversal like this, where the stock market reversed in late October, early November of 2020. You can pause your video player here. This is growth stocks relative to TLT or Treasury bonds. I think you can make a rational argument that this is the weakest momentum profile looking backwards here. For example, here when momentum was relatively weak, it was able to come back up into overbought territory. Really haven't done that in a convincing manner in the present day. Also, the 30-day rate of change for this ratio really looks worse than it has at any point looking backwards since the March 2020 low. A look like this can obviously improve as it did here, but it hasn't improved yet. Triple Qs relative to TLT. This gives you a look relative to the trend line off of the March 2020 low. This is the highest high here. This gives you a little bit of a snapshot on high-low close bars as of the close on June 11th. This ratio still has some work to do. Good news, held at this area here. Bad news, haven't cleared this yet. Here's your highest high in here for this ratio. If we draw a trend line off of this low, we're still holding that trend. This might be a logical reference point in this area here if we backtrack. Also, RSI for the ratio held here and here, as did the stock market, along with the ratio. We're in the same general area now. We'll learn something either way. If RSI pops down here, that would be a little bit different. If it's able to turn like this or this, that would be constructive for shorter-term bullish probabilities. Very, very similar to QQQ relative to TLT. Indecisive with work to do here. You can pause your video player here. I'll walk through one of these. This is the correction in the S&P 500 right here after the major low here in 2009. Notice how NYSE breadth momentum basically plummets. The stock market peaks right here. If we come up, we drop below this line, this blue line, this line, this line, this line, and tag this line and drop below it. You can see something similar in all of these cases as the stock market's rolling over. This is the look of this indicator as of Thursday's close on June 10th. Right now, it looks a lot better than these cases here. Obviously, that can change very, very quickly, and it may change very, very soon, but it hasn't changed yet. NYSE stocks greater than their 200-day exponential moving average as of June 10th. Noteworthy, this up here is the highest level this indicator has reached, dating all the way back to the low in March of 2009. Didn't hit it here and didn't hit it here. When this trend line was broken here in the indicator, eventually bad things happened in the S&P 500. Thus far, we're holding the trend line off of the March 2020 low in the S&P 500 index. NASDAQ volume momentum oscillator as of the close on June 10th, 2021. This momentum oscillator had a big push here recently, and we wondered how many times has that happened since the March 2009 low. How did the stock market perform following reaching the upper pink line? The answer is 5 previous times, and for the most part, stocks performed well. In every case, the market was higher 9 months later and higher a year later. The average gain 9 months later, about 18%, 1 year later, about 21%. The shorter-term performance was a little bit mixed, helping us maintain the all-important realistic expectations about 100% normal and to be expected volatility that occurs even within the context of the strongest bullish trends. This point here where my cursor is was reached on June 10th of this year. Thus, June 10th is similar to walking forward from these dates here, and this is what happened in the stock market. How about maximum one-year drawdowns? Really a mixed bag. The 2010 case is the one that would make your stomach hurt the most. Almost a 12% drawdown over the next 108 calendar days from the date of the signal, which once again would be similar to June 10th of 2021. Average drawdown, 4.7% roughly. Median drawdown, a relatively tame 3%. When we look at interest rates, we have to consider two factors now: fear of inflation and fear of a market decline, and or fear of economic weakness, which are basically one and the same. This is the COVID plunge in the stock market where my cursor's moving here. You can see interest rates rolled over and telling us that people were buying bonds. As of the close on June 11th, we have somewhat of a rollover look. So it doesn't really look like market participants are getting more concerned about inflation. And this look here also aligns with the TIPS Treasury ratio that we've already covered here. For the most part, this is decreasing inflation expectations since early to mid-May of this year. A lot of nice reference points here. This is what bullish outcomes look like from a confidence perspective November of last year. This is what a false breakout looks like here. And this is what a topping process looks like recently in the S&P 500 in 2020. Thus, walking forward, will this be a successful breakout and retest and a higher high, something like this here? Or do we have something more like this here or here? In the short run, the ratio of global automotive stocks relative to the S&P 500 remains in a downtrend. It's trying to reverse. We'll see what we can learn in the coming days and weeks. Quick update on the daily DeMark chart. DeMark charts and indicators are proprietary tools from Market Studies, LLC. This is the slide that we covered last week. Here's the close on Friday, June 11th. I believe in last week's video we said for clients that we really haven't seen anything in recent weeks that tells us we should be reducing risk at a rapid rate. And we really haven't seen anything that tells us we should be increasing risk at a rapid rate. The same concepts apply as of the close on Friday, June 11th. It's a mixed bag. The good news, new all-time high. The bad news, there's a large short-term momentum divergence that may be cleared, but it hasn't been cleared yet. And we know the best way to handle consolidation in an indecisive market is to head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.